Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of Paris Rapeseed, Winnipeg Canola and Malaysian palm oil markets.
Paris Rapeseed. I said 3 weeks ago how it was sometimes a sheer joy to write commentaries here because of the beauty of the patterns. Well, it still is here. There continue to be two key patterns here. The first and larger one is the February 2021 to July 2022 ascending broadening wedge pattern. You can see part of the lower trend line highlighted in blue in the top left of my daily chart. To be honest, you can't really see it as it's just so large, but it is there. This was not a perfect pattern, but it had been the main market driver in the early part of 2022. The break lower in July last year left the following incredible targets on the downside, which I highlighted back at the time. The primary target X in the 352 even area were harder to reach secondary target X1 in the 217 even area. These are, obviously, well, pretty much way out there targets that you can put into your diary on the back page and just look at that maybe once a year. There was, and still is, a newer, smaller pattern, though it is still quite big on this daily chart. It is the early July to late October 2022 bearish Andrews picture, and this is where the joy comes in. The market has since October last year until now moved down within this bearish pitchfork, mainly as it is now in between the middle tine below, currently at 449, and the upper tine above, currently 519. You can clearly see the tines highlighted in purple on my daily chart. I thought back when I drew this one that it might eventually need finessing or even turning into a shallower bearish shift pitchfork, both of which I would have been happy to do in a heartbeat, but so far it has not needed any surgery and is still excellent in showing the bearish angle of attack of the market since late October last year. The only new feature was the dip and recovery, mainly last week, below the middle tine. With the recovery, there is an argument with the gap below from last week and the early one midweek also last week to look at the action as an island bottom. This all happened in what is a fairly free area, but if we look below we can see some old support from the two necklines so close together, generated from the November 2019 to February 2020 move at 398 and 399. They are close to the December 2020 low at 396 plus. We also have the lower tine below, currently at 379. Finally, there is again the elephant in the room to address, which may be becoming the beginning of a herd of elephants. You see, we had a monthly key reversal down in November last year. And whatever you do, please make sure that you take that into your calculations or your thoughts. Now, there had been a weekly key reversal up in mid-December, and we had seen a follow-through higher to that for the following 2 weeks thereafter. But prices ran out of steam on their approach to the upper tine back in early January, and the market turned lower, such that this past January would made yet another monthly key reversal down. Please consider all this in your calculations and thoughts. Thus we come to some of the nearby congestion. The market has punched up through a congestion band between 460 to 469, which has within it the 2013 high at 464 and the June 2021 low at 468. This is now support, though the effort of pushing higher seems to have worn down some of the bullish incentive. I say this because we are in a fairly free area up to congestion at 491 3/4, which relates to the June 2021 gap, which has since been filled. This next congestion stretches from 291 3/4 up to 504 3/4 and contains the July 2021 low at 497.5. Beyond that, well, we would then start looking first at a combination of the upper tine, currently 519, and the declining short medium moving average, currently 521, that has accompanied the upper tine well since mid-December last year. Winnipeg Canola. This is another chart that previously has given me great joy, but things are possibly changing here. If I take you back to late summer last year, I said at the time the following, and I quote, "Became evident since the start of the sideways to slightly lower movement seen here since June that there was a shallow bear channel." That's currently 871.30 to 757.20. And it is this that has been driving the market lower during the summer, end of quote. To emphasize this point, I further added, and I quote, so it seems that until that slightly bearish channel breaks or morphs into another pattern, it will continue to show the slightly bearish angle of attack of this market. Well, as you can see, the bear channel was still there leading the way lower until 2 weeks ago. To help, I highlighted it in dark blue on my daily chart. Now, before I expand on the break lower, let me take you back to the start of the year and another feature that has impinged upon the market. It was a June 2020 to date broken uptrend, which I've still kept highlighted on my daily chart in bright red, and that's currently at 839.20. The market came close to testing this back in early September and then again in late November, finally punching down through the uptrend in late January, and back then it looked, for a few days, like we could see this bear channel morph into a sideways triangle. However, the market sauntered through this uptrend in late February and seemingly only discovered it had done such a thing in early March, as you can see by the exploitation of the move lower at that time. Now, I've always embraced the idea of this channel being a sideways triangle with a break lower, and with all the implications that we may have. Thus, we have on that basis a primary target in the 768.5 area and a secondary hard to reach target X1 down in the 688 even area. 3 weeks ago, the market dropped down and reached the primary target. The move lower indeed looked good at the time to try down to target X1 with a seemingly little in the way apart from the July 2008 high at 710.80. However, a little after piercing this support, the market started showing indecisive actions, culminating in an outside day last Thursday with bullish tendencies, if only just, that was also bullish double. Since then, prices have moved higher, but we've also started showing some hesitation in the bullish incentive, especially as we approach the lower bear channel line in dark blue. Now, this does not mean that I will retract some of the potential targets below for the bear channel pattern, but it will cause me to look carefully at what will happen in the coming week. Thus, the primary target for this move lower has already been reached in the 726 even zone. A secondary, harder to reach target X2 is still live lower down in the 644.5 zone. Now, one final point, and it's something I've raised now some 12 weeks ago and every occasion since then. And I quote, there is just the thought of what may be the whole of April today action. It can be seen as a bottoming action. You see, it can also be seen just as it is, as a shallow bear channel, or you could look at it as part of a very large bearish hesitation. It's all still too early on these thoughts, but I think they need to be present when things start to happen eventually. And that's the end of the quote. We're closer than ever now to looking at the action as a possible very large bearish halfway hesitation pattern. Just keep watching this space. Bursa Malaysia crude palm oil. Back over September and mid-October last year, the market formed a small but effective reverse head and shoulders pattern. It was a break higher over the neckline for this pattern, combined with a break higher over the old neckline of the September 2015 to November 2017 head and shoulders top, currently 39.60, which is highlighted in bright red on my daily chart, and finally the break above the short medium moving average, currently at 39.71, that altogether caused the move up in early November. It gave potential targets on the upside of a primary target in the 42.45 area and a secondary hard to reach target X1 in the 44.40 area. In late October, prices reached the primary target, and we've come close to reaching target X1 as recently as early March, but we've not managed it as yet. I thought about retiring target X1 more than once, but cautious as I am as an individual, I've kept it on, and I will again, if only for a little while longer. You see, every time we've seen an attempt higher, we've also seen the market drop back to the seeming security of the combination of the old neckline, the short medium moving average, and the medium moving average. And I include what we have seen these past 2 weeks for a break lower to the middle tide, currently at 36.03, of the mid-August to early November 2022 mildly bearish shift pitchfork, which is highlighted in bright green on my daily chart. The market tested down to the middle line last week, but rejected it this week. And we're back at the security of the old neckline, currently, well, old neckline in red. What is perhaps interesting this time is that overhead we have all the moving averages bearing down to a lesser or greater degree, right at or near the red neckline, thus reinforcing it. There's one further feature. The action over the whole of March has set up the opportunity for March to become a monthly key reversal. Thus, if we close tomorrow, 31st of March, either over 41.29 or under 38.06, we'll be on. Last week, it looked very much as if we might have a monthly key reversal up. However, since then, with the rise this week, we are currently set up for a lesser outside month.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.